What's up, everybody? Welcome back to the Contrarian YouTube channel. For those of you who might be new, my name is Logan. I really like to talk about investing in the markets and sort of significant data points that come out with regards to the markets. And so today I'll be talking about what everyone else is talking about, and that is GDP coming in negative for another consecutive quarter. The fact that Janet Yellen and Jerome Powell are not acknowledging this yet as a recession is very significant. In any other prior past time, it likely would have already been acknowledged that we are in a recession. However, that continues to be denied by the Fed. Today I'll really dive into a lot of the data that is suggesting that we're already in a recession, contrary to what Janet Yellen thinks, and that it in fact is likely going to be a very deep recession, not a very shallow one, which is what they might be planning for in sort of a worst case scenario. So today I'll really be diving into that data. And I do expect that this prediction of hers that there is not going to be a recession this year will age just as well as her transitory inflation prediction of last year, which aged like milk on a hot day. So I'll just dive into the data. First off, basically GDP came in at a negative 0.9% for Q2. That's a little less than what the Atlanta Fed was predicting at a negative 1.6%. But the first quarter was at negative 1.6%, so still 2 consecutive quarters of contracting GDP. Technically, that would be a recession, but Janet Yellen frequently is pointing to the labor market as being very strong. While this might be true, there are some very ominous signs when looking at the labor market, predominantly having to do with a lot of the most significant players which have played into growth in the labor market are actually beginning to lay off employees or at least slow their hiring. So you have no further to look for this than with companies like Alphabet, Apple, Google, big tech companies. They have all slowed their hiring efforts dramatically. Someone like a Tesla, they've actually been laying off 3.5% of their workforce. So this is really not a good sign for Janet Yellen's argument. So data really points otherwise to her claim that the labor market is very strong. Now, it might be strong looking at some of her highly manipulated data in terms of unemployment, or it has been manipulated for a long time at this point, basically ignoring people who are no longer looking for positions, etc. So they're likely looking at some pretty manipulated data out there, and definitely data that is looking in the rearview mirror. So they're not looking at current data that can be found out there. Basically, you can look at this chart here that I actually found out there. TrueUp has a very helpful chart just showing the last year of layoffs that have occurred, number of tech employees let go. So it is in the tens of thousands at this point, and it just shows that an industry that used to be very heavily in the hiring category is now beginning to lay off employees. So this is not a good sign for Janet Yellen. Also, they've been decreasing the number of openings for tech companies. So not a good sign for her. Just a different article pointing this out. Layoffs of different tech companies, Microsoft, Google, the latest tech titans to hit brakes on hiring. Now, a lot of these companies, it would make a little sense for them to be laying off employees. Some of them were somewhat bubble type companies that weren't really doing much of value to begin with. Obviously, I'm not referring to many of the big tech companies, but something like a Carvana or Coinbase or even Tesla got very overextended in terms of expectations that they were perhaps planning for that didn't turn out as they were hoping. So it would make a little sense for companies like a Robinhood or Coinbase to be laying off employees simply due to the very volatile nature of what Coinbase is doing or what Robinhood is doing. It's basically dependent on the cryptocurrency market continuing to do well. So it would make a little sense for them to be laying off employees since cryptos really have been one of the big laggards of this year. But it's not just the small tech companies, it goes all the way up to the big tech, which is not good news for her because tech has been one of the most consistent hires in the last 1 to 2 decades. These companies basically have always been growing. Google has always been hiring, looking for new people, etc. So basically the Fed is unfortunately stuck looking in the rearview mirror. It's just employment data that is not really reflecting what the economy is actually like. Um, Even a CEO like Elon Musk, he is somewhat upfront about his thoughts on the economy, the current state of the economy. Even in the last 6 months, he's put tweets out there saying that, we're likely heading into a recession, that he would be laying off a large percentage of Tesla's employees. So even as much as I disagree with Elon Musk in certain things that he does, I do think that, at least in terms of what he's saying, it's usually what he's actually thinking in his mind. So that's just a little side note. But going into other data that really suggests that we are currently in a recession, and a significant recession, is that the bond yield curve has basically never been this inverted, at least looking on this chart that I was able to find on Bloomberg that goes all the way back to 2001. So basically, in the last 2 decades, the bond yield curve has never been this inverted. And this is a very bad sign, because whenever the bond yield curve is inverted, that essentially is saying that investors are willing to earn less of a return owning longer term bonds than short term bonds. And it's basically always the inverse. In a healthy economy, you would expect to earn a higher rate of return if you're lending your money for a longer period of time than a shorter period of time. It's just, that is what the bond market, that is how the bond market typically behaves. But in a recession, since investors are so fearful in the short term, they're much more willing to purchase longer term treasuries than shorter term ones. So that is all the bond yield curve looks at, is the difference between the 10-year and the 2-year bond yields. And so whenever it goes negative, whenever the 2-year is yielding more than the 10-year, that shows several things. It shows that, first off, that the Fed has usually done more rate hikes than are needed. And so at some point, that does force the Fed to step in, usually. And in the last decade, since they invented quantitative easing, they've stepped in to purchase bonds on the shorter end of the curve to lower the bond yields, and to try to get it back to a typical bond curve, a bond yield curve, basically. So at that point, investors are more hesitant to get in on the shorter end of the curve until things begin to straighten out in an economy. So basically, the bond yield curve inverting shows us that the Fed has basically gone too far in their tightening already. Even as little as they have done, they've already gone too far in terms of that already impacting the economy in a very dramatic way. So it does show us that we're probably very close to the end of the tightening cycle in terms of how far it can go. Obviously, with them just hiking rates on the short end of the curve another 75 basis points this Wednesday, that just made it even more inverted. Now we're more inverted than we were during the Great Financial Crisis period. So we will have to wait and see how long it takes the Fed to wake up to this reality of the bond yield curve being this inverted. Another data point I will look at is the General Business Conditions 6 months ahead survey. It has very accurately predicted past economic periods of recessions, basically looking at businesses, what they are forecasting for 6 months in advance, what their business actions are based off of that. Basically, you can see whenever it's gone below zero, like it did very briefly during the dot-com deleveraging event. It very briefly did during the Great Financial Crisis, actually towards the end of it. And then COVID, it briefly touched zero right there, but we're actually already below zero right now in terms of a percentage. So this is very significant in terms of manufacturing industry. They are not planning in advance to grow. If anything, they're wanting to decrease their inventories. So yeah, it basically indicates nothing good for Janet Yellen's argument. Copper is also very reflective of this. The copper price is coming down very dramatically. Also the case with other industrial commodities, or lumber going into home building. That has come down very dramatically, which shows a significant decrease in the number of homes and everything else that lumber goes into producing. So all this being said, Janet Yellen's claim that the economy is still strong, that labor market is showing that, is very backward looking. If the Fed was looking at current data, they would not be this optimistic. Um, and basically, the White House almost planned in advance for this event of a second quarter GDP coming in negative. They said basically a few days ago that while some maintain that 2 consecutive quarters of falling real GDP constitutes a recession, that is neither the official definition nor the way economists evaluate the state of the business cycle. So basically, they would say that the labor market, even though I just pointed out that it's beginning to show some serious declines, they would say that that is still strong. So basically, Janet Yellen has been saying in past interviews she's had, even in the today when the GDP release came out, she said that she would be amazed if this was a recession. So basically, I believe that this will age just as well as her transitory inflation talking point a year ago, which was very, very incorrect. Inflation went way beyond her expectations and everyone else's in the Fed. And unfortunately, that's because they look in the rearview mirror with analyzing and with the actions they take. And unfortunately, I think there's probably some politics playing into it as well right now. It is an election year. They do want to perhaps be as favorable as they can to the current administration because that's technically who they are working for. So unfortunately, some politics are probably playing into it as well. But basically, the Fed has always been behind the curve whenever they have acted on anything. It's just a little bit worse this time in that even though they now have this strong indication that a recession is here, they're still at least vocally ignoring it when asked about it publicly. So they'll be way behind the curve when they do act on the recession. Eventually, they will pivot, they will begin easing again. And unfortunately, at that point, they'll be way behind the curve. So they will way overdo the easing cycle. Most likely, they will way overdo it. And you could see the balance sheet of the Fed jump up very dramatically, kind of like it did during COVID. Although this time, there likely would not be a sort of external reason for doing it. It would just be because the economy would be in shambles at that point. Eventually, it will not be possible for the Fed to deny that the economy has slowed so dramatically. I don't know when they will eventually shift their minds, what sort of data will indicate that to them. I imagine it would be some delayed release of labor eventually getting bad enough for them to take a look at it. Maybe inflation, which I do expect to actually come down as a result of the recession we're currently in. Maybe inflation eventually gets down low enough to where they're willing to sort of balance the two more evenly, because right now they're really focusing on inflation entirely, bringing inflation down, and they're not focusing on how this has dramatically impacted the economy. So all of this being said, I hope you guys found this video helpful, just some important data to take a look at, to be aware of right now. I wish all of you the best right now. I hope that this recession we're currently in isn't impacting you in a significant way. But if you guys have any comments or input on this video, just leave them down in the comment section below. If you liked this video, just consider giving it a thumbs up and subscribing to the channel. And I hope to see you all again at some point.